Hi guys, thanks for tuning in to another episode of Nuggets News. Well, it's been a massive week. I've got another action-packed show. So excited to go through all the macro headlines as well as the crypto news. We're going to tie it all together, and it's been a huge week for so many coins as well as the stock market. So look, this week we do welcome a few hundred new subscribers. I was only able to get out one video this week, a really important one that I suggest you watch. As you know, I haven't been able to do as many videos lately. I've been working on an Ethereum documentary, which you'll find more out about very shortly. But I've also been spending a lot of time with my pa, who unfortunately did pass away this week. But at 86, he had a great life, and as you guys have probably heard me talk about a lot over the years, I just loved talking about the olden days and how the world and money and everything had changed. So the apple doesn't fall far from the tree, as a few of you said. Well, very lucky for Pa to even meet Louis, and not many people get the chance for 4 generations to get together. So that is that, guys. I did want to share that with you. I know we have come really close on the channel, so something special to me that I just wanted to start the show with there. In terms of the month, it's been another record month at Nuggets News. We did welcome 400 members last month, and some incredible business developments. I'll let you guys read over that. We do share these things on LinkedIn and our Twitter and Facebook pages if you're interested. And we've already broken that record again this month. We've had 500 members join since we put out that report a couple of weeks ago. So look, welcome to our 261 new members so far this week. Sunday is by far our busiest day, so hopefully we get some more in this evening. When you are joining, guys, we've just been overrun. We've got a number of support staff. They're doing their best. So please read all the rules for posting, the member directory, all the welcome material, the pin post. That will show you where everything is. All the education and my research and portfolio is in the learning units. And we have also started onboarding a few of you into our new platform, which I know so many of you are hanging out for. So you'll be hearing the updates about that as well in the coming days and weeks. Let's get into the local news. So more forecasts out from the Treasury Department. We are obviously running a huge deficit at the moment. Like a lot of countries, we're in a better position to start off with, but the conversations have started around low interest rates for longer. Population growth is actually slipping. Now we've started to see, and I've actually heard some friends, so congratulations, those of you that have fallen pregnant during this time in lockdown. So maybe we will see a baby boom, but we also need to acknowledge the other side of it. That a lot of people are putting off having children because of all the uncertainties. So just today, again, Victoria, number of cases are still climbing, as well as deaths. We're starting to see a few more cases in New South Wales. So I know they really want to go for that complete shutdown tactic and get it to the point where New Zealand got it. We don't just want to be in this no man's land, which is really frustrating for me to watch this play out, and for those of you that want to get back to your jobs and go back to normal life. So unfortunately, because this is happening, all these businesses are facing a huge financial and fiscal cliff. Now, the government have put some more measures in place, but interestingly enough, I talk about Philip Lowe so much on the channel because he is different to some of the other central bankers in a lot of ways, whereas he's far more open about what he does and doesn't agree with. So he doesn't agree with negative interest rates, and he doesn't agree with this idea of helicopter money or modern monetary theory. So he's really been clear to stamp that out. And where I can see that this is going to add friction is where other countries start to do this, but he's already been vocal in saying that it's not going to work. So that's going to create an interesting mix. And now a lot of economic commentators like the Kook are saying that, this is just all big fantasy, and these guys have got nothing to debate and come back with when we're talking about it, and saying it's more and more absurd and frankly pathetic. But as I kind of replied to him here, how can you really say that we shouldn't be trying other things? It's so clear that our current economic model doesn't work. We keep going to crisis after crisis. They're bigger each time. None of the experts whose full-time job it is to see it coming can ever get it right or predict these things. So how can you say that something else is a bad idea when what we've got at the moment is just terrible and not working at all? Now, the other big news was the fact that the regulators aren't going to appeal the case against the big banks. So this was a result of the Royal Commission where we found systemic fraud. I won't go into all those things today. That would take over an hour to talk about what the banks are up to. But the Reserve Bank of Australia, so the RBA, Philip Lowe, as well as the Treasury, so, government, Josh Frydenberg, they got together and privately warned regulators that this would exacerbate economic uncertainty. So in other words, we can't really afford the banks getting in trouble or fines or more headlines because that could create uncertainty in the property market. We can't afford prices to go down. And to me, this is another example of the housing market being above the law. Our big property bubble, when you're starting to not do the right thing legally, people that should maybe be in jail or people that have had their lives ruined from not being assessed properly or whatever it is, to protect the property bubble, that tells you that if something is wrong, and we've got to stop trying to keep pushing up the price of property. So yes, property is in uncharted waters. Migration, one of the big drivers. If you watched our documentary, you know that we've got those couple of 100,000 people. That's been one of the biggest boosts to the Australian GDP. And when you look at the real growth numbers of our economy, it's not that great. And if you take out the migration, people coming in, we've actually been shrinking in terms of our GDP for a number of quarters now. So speaking of uncharted waters, China's won control of the South China Sea. This is continually disputed on and off between the US. Look, Australia sort of has their part to say every now and again, but this is heading towards something nasty. And this week we had, the US come out pretty clearly and say that we need to have some sort of uprising or stand up for ourselves against the Chinese. And this is something that divides the community. They're our biggest trading partner, but America is kind of our ally, almost like our older brother, that we do whatever they tell us, or we're scared to not do what they tell us. So very, very interesting dynamic that Australia is trapped in the middle of as we speak. Another thing I just wanted to share was the Three Gorges Dam. So I've still checked a number of sources, and some people are saying that, this is something that they followed closely for years, and it's slightly moved, and there's been engineering going on. This is a massive dam in China, and others saying that, no, this is all just, Photoshop. There's nothing to it there. So, look, if you follow this closely, let me know down below or share some good resources because apparently the Three Gorges Dam is structurally compromised at the moment, and there's a lot of people at risk if that were to break. All right, so the US orders China to close its consulate, and we're seeing, again, the evacuation of different embassies and consulates between the two countries. We've seen all those documents. You might have seen the footage of them, the Chinese, lighting all these documents on fire before the US come in and kick them out. So, things are really getting nasty between these two trade wars, tech wars, IP wars, and now the travel wars. And Australia's also, I guess, added to those, warning our citizens against traveling there at the moment. So, look, it took 99 days for those first million cases. Some people don't like these stats, 43, 28, and now just 14 for that fourth million. Because we're doing more widespread testing. That's certainly true. So the statistics we need to keep our eye on are definitely the death rate. Now, some people are saying, oh, look, there's less flu deaths this year, and that means that they're counting the COVIDs. But guys, there's less flu and a lot of contagious diseases because everyone is in isolation. That's why there's less flu going around this year. And the same applies for COVID. If everyone was out doing their normal thing, flu cases would be up, but COVID cases would be far higher, like we've seen in these other states in America where they've been overrun, and it's consistently here at over 1,000 deaths a day. So look, I understand the arguments. Some people saying, oh, they're counting a lot of deaths that aren't specifically COVID, they had a comorbidity, but we've also seen a huge increase in the number of people that are dying at home on their couch, and they're not being counted, and they are COVID statistic if you look at the statistics and the outliers here. So look, it doesn't really matter. It all comes out in the wash. What we know, and looking at the experts and the hospitals, is how quickly the healthcare system can become strained. That's what we need to avoid. So if we can get back to work in the economy and wearing masks and washing hands, and we find that it does only really affect those over 60s if we do all these other things right, and we can get some more data about immunity, look, maybe we can go back to some sort of normal economy, but it's just too many unknowns for, I guess, those in charge to let it go back and get it out of control at the moment. And I know there's plenty of you in the comments that disagree with me there, but everyone's entitled to their opinion, including me, guys. Okay, so some more data out this week that antibodies are fading rapidly. So once you've got this, even within a few weeks of having this virus, you lose that immunity. And that is, again, that is really hard to try and find a vaccine or targeted medicines against if it's constantly changing or if our antibodies don't persist. We can't get our immune system to fight it off. So 40% of American adults are actually susceptible, and people forget this. In America, these stats, obesity, even if you go down a notch and classify people as overweight, I think that's closer to 50%. So all these people with underlying conditions and diabetes, these types of things, they all can affect particularly your immune system. And what we're finding is COVID is more of an immune sort of cascade disease, blood clotting, those type of things, rather than just the flu, the lungs, you can't breathe, you need a respirator, which we initially thought that it was. So United CEO expecting airlines airfares to drop, and of course, look, these numbers, even at 50%, are probably really ambitious, but this is what businesses are now going to start to plan around. Until we have good treatments, that's really, we're not going to have any confidence until then to be able to do projections. So the share of permanently closed businesses is rising. In America, we've got some data out of Yelp. It's something like 55-60% of restaurants are now permanently shut. They're scarily large numbers when you consider that the US is a consumer economy as well. A lot of people just go into the cafes and out for dinner. That's a huge part of the US economy, as well as all the tourism. Now, the US is on the verge of lockdown 2.0. And once again, we've got these different leaders and governors, and some of them dislike the president, and he's putting in the armed forces to help out. So we've got this very messy situation where I just don't see that the stock market can continue on like this unless the Fed pick up the slack again, which we're going to get to. So we've got this onward march of all these zombie companies that are just being kept on life support more and more, and all they're doing is they're delaying the inevitable. And they thought that we could bridge this gap, that it was maybe going to be 2 or 3 months. But what we're finding out now is that it's actually a lot further along than that, and we can't just keep that going, or it's going to be enormously politically, I guess, expensive to keep doing this. Can America go into another $2-3 trillion the next quarter, and who's going to buy their bonds, which we'll get to in just a second. So the jobs picture is worsening. We do look like we're going to have possibly anywhere from 10 or 20 million people losing those benefits, or at least the extra $600. A lot of people looking like they might get evicted. If we actually look at the number of people that are employed, it's just that figure that's dropping. So yes, we can sort of bend the statistics about unemployment like we've seen in Australia, but at the end of the day, even that's not that flash. So 31.8 million, this is the continued claims. And that's a lot of people. And we had seen a bit of a bounce in sort of retail spending. A lot of that was maybe clothing. Now, some people shared this article with me saying that they believe a lot of the spending is coming from the kind of the prepper resources. So whether it is your protective weapons or clothing, the canned food, they're the types of numbers that they believe are inflating the retail sales. So let me know what you think of that one as well if you're in the US. AT&T have told us that over 300,000 mobile users stopped paying their phone bills during the COVID panic. Look, I think the big one is really the renters and the apartments. The worst is to come. We keep hearing about this, how many people are going to be kicked out. Now, do the banks really want all those properties like back in the GFC? Who's going to buy them off them eventually? Do they want to maintain them and upkeep them that year or 2 years later when they start to, decay? So look, all these things come into it. And I know we think about banks as really greedy, but it gets to a point where, yes, they want to take your house with the money they got to lend to you out of basically thin air by the time we take into account all these fractional reserves. But to them, it can actually become a liability, even though they get it for free once they have too many to manage. So rural real estate is becoming more attractive. I've touched on this topic a number of times now, where I'm hearing the stories firsthand of people that have come from, Paris back to Tasmania or the New Zealand. Where are these prime real estate where you can go out of the way and have your own little slice of heaven? Fresh air, is there fresh water, good food, beer, wine, those things that particularly the wealthy, that is what they want. And some of these regions do offer it, and they're not the typical places where we saw high priced real estate. That typically was in the CBD or the nearby suburbs, so that you could go in and work at your high rise building. All that is really changing at the moment. So these brick and mortar stores, malls, these are the guys that are feeling it the hardest. This is one of the real estate investment trusts. You can see that has been smashed down 80-90%. I think there was some more statistics I did want to show you just here. So this is the commercial mortgage-backed security delinquency rate from 4% up until 18%. And they're the types of things which affect the bank's revenues. They're leveraged up. That's why the banks are trying to raise the capital that they've got, the reserves, because they're just not getting any of that money flow through. And they're not actually lending out to the small businesses either. All this money the Fed is kind of printing, they're quite happy to sit on the reserves because they can see these huge failures and bankruptcies, delinquencies that are just coming at them. So look, home prices in the Hamptons hit record highs, and this is the two-tier market economy. Like I keep saying, inequality is growing. And if house prices in Australia, for example, are going to keep going up, the only way I can see that happening with the employment picture and the inflation picture, that's not improving. So the only way this can happen is if the guy with 3 properties ends up having 6 properties, 7, 8, 9, 10. They're the people that go to the bank. They've already got the portfolio of stocks and assets that they know that the central banks are going to print that money. They're not going to take the risk on lending to the little guy that doesn't have a lot of assets or doesn't have that higher income. And that's where we see this inequality widen, as well as at the top end of the spectrum where the Hamptons, like I just explained and described, they want to go somewhere that's out of the way, particularly when we're seeing civil unrest increase. At the same time, in the cities, we're going to have the rise of these delivery robots. And we've already seen it in the McDonald's. You go in and you type the menu yourself. So more and more of these jobs, these robotic type jobs, they've actually got another, edge to their sword now because of the COVID, the germs, the health factor that businesses can't take the risk on. If this is going to save them money and it's less of a risk for the health insurance they might have to provide, for example, a robot doesn't get sick. So permanent versus temporary closures here, and the number of businesses, we continue to see these rise. This is the actual hard numbers on Yelp, like I was talking about before. It's climbed to over 50,000, so more than double just in the past couple of months. Make sure you're following Jesse Felder on Twitter. He is brilliant. Main Street, their lending program is just broken. It's too stingy. Banks and borrowers designed to save all these mid-sized businesses, but they're just not lending, like I spoke about before. And this is where Congress and even the Fed, they need to be focused here. Look, they don't need to save the big end of town. Big tech have got all their cash reserves. They're not going under. It's the small businesses, the lot of friction and paperwork to start up a business and to hire again. Once you lose that, a lot of people are mentally sapped as well. They don't want to start a new business. It's just too much stress as well as risk. So companies are flooding the market with hundreds of billions of dollars of shares. Once again, this is the example of the small cafe can't do this, but the big end of town, they can issue these shares. There's Robinhood investors that are going crazy, passive investors that are just buying the ETF. So they know that if their stock is in an index or these different portfolios, these shares are going to get gobbled up. Then you've also got the debt issuance. A lot of these companies are issuing all their bonds, like we see here. So this is only, ticked into July, and we've already, more than doubled the record amount of bond issuance. So these are investment grade corporate bonds, the better companies, exactly like we're describing. So the better companies that already have a lot of money, they don't need $800 billion. but they're issuing it just because they can get it. And it is wrong, in my opinion, that the Fed are buying these bonds off Amazon and Apple when they've already got hundreds of billions of cash reserves. Just not fair. Now, at the same time, with all this happening, we see the same insiders that actually bought shares near the bottom, they're now selling. So all the execs, they are selling their shares because they know that things are bad at their company. Look at this ratio of insiders. And when they're selling, this is when it's bearish. And we've surpassed that level now at a ratio of 44-1. So really, really crazy stuff. And I don't know how this is even, I guess, allowed. It's so clear that it is wrong, morally, but it continues. Okay, so one of the insiders that's doing this is the Fed's, or BlackRock's, I should say, that's been hired by the Fed, Larry Fink. So he continues to sell his own chips. He gets to buy his own shares, choose what goes up, and then he gets to sell his own stock. And so far this year, he sold $75 million. So absolute socialism for the rich, isn't it? If people understood this, I keep saying it, there would be more civil unrest. You saw what happened back in the last financial crisis, and if you haven't, please go and watch the clip I made called Top 10 Finance and Economics Documentaries. Get educated about what happened in the GFC, because the exact same thing is happening again. We can see these are the money flows for US domiciled funds, and once again, they're pretty happy to go into fixed income now that they know that the Fed and these companies are being saved and bailed out. They're happy to buy their bonds because it offers a higher yield, whereas they're actually going out. They're net sellers of equities, of shares. Here we can see the different countries and their exposure to different asset classes, and we can see that, for example, in China, only 7% of households have shares, whereas in the US, we've got 32% allocation to equities. That is a really crazy statistic, isn't it, when you consider how few Americans have shares, and we know the wealthy have the majority, and this sort of averages out to still quite a high number, but there you go. When we look at the different age brackets and those US equities, obviously the less than 40-year-olds have got the lowest amount by far, but back in 1990, they still had 13% ownership of the US equity market, whereas that's fallen to 4%. So look, what's that? 2-3 times worse off than what they were. It is, when you look at this number that's basically gone sideways for the best part of 25 years, when you look at all the wealth that has accrued, we do have to change something. We just can't let this continue on. So now that the market's in its final stages or going parabolic, it's not really the time to be buying, all things remaining equal. The time to be buying was any time in the past 20 years. But we've got these people, the day traders, piling in. I've told my wife I'm going to be a millionaire even though I'm unemployed. We've seen the aggressive numbers of signups to new accounts, whether it's Robinhood, Charles Schwab. Average revenue per trade, it's got cheaper and cheaper to the point where a lot of these are free as well. And we see things like it's the narrative that is driving the investing rather than any fundamentals. So searches for tech stocks at an all-time high. We see the NASDAQ is broken or equal this record. So this is the number of days without a back-to-back decline. So it hasn't gone down for 2 days in a row for 48 days now. And that is equaling the record from way back in, 79 or 80, 40 years ago, right before that, the 1980 crash. All these big tech stocks, 11% of the S&P 500, all that concentration of wealth. These are the stocks that are being dragged in front of regulators at the moment for data, for mistreating their customers. They are reporting that sales aren't great, but that is not stopping all these retail traders that are just speculating. Look at the volume of options here. So these are new traders, retail traders that shouldn't be trading options. And the number of contracts that are trading compared to 12 months ago, 500% increase, these kind of numbers. And it is happening. This is why the market is going up on thin volume. iPhone sales are stumbling. consumers are turning to a cheaper alternative. At the end of the day, when you've lost your job, that iPhone, that logo, that symbol, it doesn't mean much when you can pay either $1,000 or $200 and you can still call someone or still go on Facebook. So they're the sort of things where people are going to, I guess, reassess what's really important to them. The Fed's weekly economic index, it's turned down again. They know this is coming. When you have a look at these stats about the performance of stocks, these are the very interesting numbers. If you had have just excluded the 5 lowest return days, even better again. So if you can avoid the big down days, that's fantastic. But if you actually miss the 5 best return days, you miss a lot of the returns. You're actually even down slightly. So that's a pretty surprising figure, isn't it? And wouldn't it be nice to be able to pick the best and worst days? Another interesting piece of data that I saw this week was the performance in regular trading hours versus extended hours. So what it's kind of saying is overnight, when most people aren't trading, particularly day traders, retail traders, that typically tends to be when there's better performance of late. So the people that are trading during the day are performing worse than the market, and that's all the retail traders. Market breadth, the number of stocks below their 52-week median, it just grows and grows. We haven't seen it this low since way back as we're heading into the .com bubble bursting. Jeff Bezos, obviously he gets to benefit when they sell all those bonds, that $800 billion figure. His wealth has gone up $13 billion in a single day. And now we get into the Fed talking about, well, what happened? Why did that crash occur and we couldn't see it coming once again? So we've got different theories coming out, blaming shadow bank weaknesses, so the second tier, all these neo banks and what the Fed kind of can't control. Bernanke and Yellen are talking about the Fed need to find out, why this happened. Well, shouldn't you guys know? You've got access to every piece of data there is. This is why the Fed had to step up. And it didn't happen, remember, it didn't happen in January or February when COVID started. This was back in September when they had to start saving the repo markets because there wasn't enough money and lending in the banks. So the JP Morgans of the world shut up their doors and said, we are not lending to these other banks. We want our reserves like they're doing right now. They wanted their reserves. They weren't willing to lend to other people. So the liquidity in the system has absolutely collapsed. And what you can see here is human versus machine trading. And it's particularly when COVID kicked in. I actually made a video about this right at the peak last year. If you want to watch it, just search for high frequency trading on our channel page. And I spoke about how this liquidity, all the traders and bots and all the volume will be pulled. All the algorithms will stop trading when we have a crash. And that is exactly what happened. Look at that fall from 2,400 to down near maybe 200. So a 90% decrease in liquidity at the time when you need liquidity. And so the funds that run all this stuff, they kind of know that they've pulled their bots and liquidity. And it's almost like I've been talking about, they arm wrestle or they try and bluff the Fed. And the Fed fell for it. The Fed printed trillions of dollars to pump this liquidity up back into markets. So when we have a look at what the Fed are holding or buying, we can see that they actually really tapered off their bonds and the notes that they are buying. And it's been a continued increase in more of the public debt here. Even that has tapered off recently, though. What we have seen continue to increase aggressively since April is the mortgage-backed securities and commercial mortgage-backed securities. So people that are defaulting and delinquent on their mortgages and all these empty high-rise buildings, they're all bundled up into these real estate investment trusts and these CLOs. It's that house of cards that is going to collapse unless the Fed don't keep buying trillions of dollars of these assets. But what is it doing? It's bailing out the hedge funds. And they know that, well, we can package up these crap and sell it, and maybe it is giving 7% yield and it should be risky. But it doesn't matter, because if it defaults, then the Fed will buy it off us and we'll tell them the price, or we'll crash markets until they come in and pump the price back up, and then we'll sell it to them. So this is the no-loss situation that they find themselves in. And sure enough, Mnuchin's saying that more stimulus packages, they're not going to be a bailout for mismanaged states. So this is now talking about all the pension funds and the state funds that have got no money, and now they've got to be bailed out as well. So who's going to bail them out? Well, it's the government that have to spend it, but the Fed have to agree to print this money unless we go down the modern monetary theory path where the government says, well, stuff the Fed, we're just going to spend. We're not worried about inflation. And that's when Trump can promise everything to everyone once he's in charge of the spending. And that's when you get inflation. So look, McConnell's saying that we need another shot of adrenaline. Right in time for the election, I think you can almost guarantee you're going to see at least one, if not $2 trillion stimulus packages. We've already got $1 trillion shortfall. So this big glut of bonds that was sold by all these different central banks, but no one sort of stepped in and bought them. So the central banks kind of said, well, we are not buying those. There's only so much that we're agreeing to buy. You can keep issuing them and the market's got to absorb them, and maybe it will, maybe it won't. But so far, the market has really ignored any signs that they've printed too much money or issued too many bonds. And if you're issuing those bonds and you get all the money, then there's going to be inflation at some point. But so far, the market is not worried about that or pricing it in. And this is because, well, you see here the Fed, they've really had to step up. And they're now on par with the Japans of the world, where we see that they are the main holder of Treasury debt. So like Japan, their central bank owns all the bonds that they print. And this is the scary thing. When no one else wants your debt, that's when your currency can start to weaken. So this is Raul, and he's tweeted out the bond yields here that are finally look like they are breaking down on the US 10-year bond. It's down to around 0.5%. And people are saying, well, you know what? 0.5% is not that great when they're printing all this money. But more importantly, it's the real yield. So although interest rates might be set to 0 at the Fed and they're 0.5% on a government bond, inflation is starting to rear its head. We've seen the cost of food going up, say, 3%. But if we have a look at the shadow stats and these alternate figures, they're still far closer, the real cost of living, to maybe 5%. If we use the metrics by 1980 standards, it's still around 8 or 9%. So when you think about that, the real interest rate is actually worse than that. So they're saying it's -1%. It could be anywhere from -5 to -9% if you want to use those other numbers. And that's when people start to say, well, hold on, there's no way that I'm sitting here and letting those negative interest rates eat away at my wealth. So the Fed may not recognize this inflation until it's too late. They've been very bad at predicting basically everything. But it's the dollar that might be losing its luster with all these different investors around the world. And that goes against the US dollar milkshake theory. And we are waiting to see if this is a short-term thing, because everyone loves picking on the dollar at the moment and saying, well, it's losing its luster now that interest rates are low and this, that, and the other. Of course, the US can never pay back this $27 trillion of debt. They can't grow their way out of it. At the moment, if they have to do that bailout for another quarter, we're talking trillions of dollars again. So this can grow towards 30 trillion by the end of the year. But just look around the world. The EU reached another $1 trillion deal on the back of the coronavirus. So it's basically the same or worse in every country. So as long as the US is the world reserve currency, I think they're still going to have a lot of advantages. And other countries aren't going to like that. Again, leads to the friction and the trade wars and the currency wars. Now, on top of all of that, we've got the upcoming election. So we've got Biden that's talking about rising the taxes, but we've also got, for the first time really, Judy Shelton, who's a big gold advocate, spoken about a new currency or a gold-backed currency. Probably good for crypto as well if she's good for gold. So look, that can really shake things up, and she got through the next stage this week. I think she goes to the Senate, is that right, next week? But man, if she gets on the board, that is going to really shake things up. So here we can see gold following those negative real yields. So this is the gold price inverted. So the lower those real yields go, like I spoke about, -1%, hey, maybe it's -5 or 9% in reality, and that's when gold can go to those astronomical numbers we hear, maybe $2,000, $3,000, $5,000 over the coming years. Now, it was 5 years ago to this week, I think roughly, when I remember this clearly, because at the time it was that sentiment that I always harp on about. Sentiment was horrible in gold and silver markets, and this article was very popular at the time, calling gold a pet rock because it doesn't offer a yield. Nobody likes it. Price had been going down for 4 years at the time, and sure enough, that marked the bottom. It's those extremes in sentiment. And funnily enough, check that article out. I tweeted it today. Read that at the time. That was the attitude of gold. Investors' attitude towards gold. Now, smart money doesn't like stocks at the moment. Like we saw, they're rotating out of those, but they are going into gold. And sovereign wealth funds, I keep talking about this over the years, they've got the tiniest little fraction of a percent exposure to gold. And it only takes the tiniest little doubling of that fraction, and look what's happened. Gold went up $100 this week. Now that's 5%, but on a $10 trillion market, that $500 billion in a week, that would be the equivalent of Bitcoin going from its current price to around $30,000 in a week. So a lot of money flowing to gold, and there's still so much money or currency on the sidelines. So more and more of this flowing into the gold ETFs that are physically backed, and they have to buy this. So if you are going to use an ETF, make sure it's one of the ones that has to buy the gold. And it's Wall Street that continually go through this cycle. Now that they're happy with how much gold that they own, they've probably bought all the stocks, they're happy. Now they start printing these articles about how they're bullish on gold, and they're recommending buying of the gold miners to their clients now that they've got their positions and filled their own bags. So more physical gold just being delivered on the COMEX. We know there's huge demand. I did a video about gold miners and the indexes. This was back in January. GDX was 28 at the time. I think it's now up 50% to hit 42 this week, 41 there. That's been fantastic. You can hold these for, again, the zero fee trading that is dangerous. Use it to your advantage. If you are planning on getting exposure to these things, you can trade for no fees and hold them for no fees and be sensible about it. Don't overcomplicate things. The other tutorial I did was about taking advantage of the price suppression. So when silver got down to $13, I said, we can arbitrage this, the market manipulation. And sure enough, the price for physical silver may have jumped $5 an ounce, but silver has now jumped $10 an ounce. And so that difference, that spread has closed just like we said, and we can now buy 50% more silver, exactly like I outlined during this video when markets were crashing back in March. So look, I did a more detailed write-up for members, but this is just such a good example of understanding how markets work and taking advantage of that to get huge returns. So fantastic stuff. We've also got our silver reports. These are just educational. This was one from back in November where we spoke about what the top funds and what the silver stocks are that they hold. These are the things that are more likely to run when the other funds start to look to invest in silver stocks. So look, all those reports are under the units tab in the group, guys, and they will be available in the app and the new platform very soon as well. So we do have that deal still going. If you're planning on trading or investing, that $100 free Bitcoin when you do sign up with that link down below. But it is time to get into the crypto news. As you can see here, alts have been on absolute fire. This was just in one day, a bit of a snapshot this week. The low mid-cap coins were all pumping. And remember, all those people that told you that there'd never be another alt season and it was a bubble, and I continued to disagree with them. I held my position firm, particularly on Ethereum, and we are now seeing that pay off. So look, I'm going to talk about it a little bit more. We're starting to get a lot of excitement. I spoke about the number of members, a bit of a Richie Benno dad joke here for you guys, but I do obviously appreciate when you guys are giving us the, thanks for this nugget and just paid for my yearly membership and these types of things. A lot of excitement here, but it's time to take a deep breath. And that's why I did this detailed video at the start of the week. So when we've got these coins, this week marked Matt and I both getting our first 100Xs. So synthetics going from 4 cents to $4, and Matt covering Aave. I'm not sure what the price was, but a 100x return from then. These are crazy returns, and people are piling in. Noobs are piling in and saying, should I just buy DeFi? And the answer is, well, probably not. Whenever a chart goes parabolic and looks like that, it's probably not the best time to be buying it. You've got to be looking elsewhere. And I'm already starting to talk about the next sector or the next coin and assets that I think money's going to rotate into. While, unfortunately, it happens, doesn't it? You see it firsthand. The herd, those retail investors, they pile in at the wrong time and do the wrong thing. So please, guys, if you haven't already... If you're misunderstanding a lot of the terms in these videos, we keep getting asked this as well. Head over to the website. We've got the acronyms and glossary there as well. But watch this video where I spoke about the bubble and how to play it, what I'm thinking. I outlined when Ethereum was still under this trend line at 240 last week about how I thought a lot of the DeFi money would rotate into Ethereum. And it has this week. We've passed $300 this morning, which is fantastic. Okay, so into all the news. I want to start off with a bit of a joke here. So Prime Factor Capital is shutting down, citing lack of capital as the prime factor. So there you go. I thought that was a little bit funny to start with, but there are other funds that have got the capital flowing. So BitMEX is leading this $3 million round into a South African crypto exchange. So basically every country on the planet has now got a crypto exchange, but we're also starting to get some of the licenses for those security exchanges. ERX got their securities license in Thailand this week. T0 has launched an Aspen coin for the ski resort as a digital security now. So this took a couple of years, but it looks like we are starting to get a bit more excitement around the securities. But not only that, we've got this, argument about who is going to win. Is it the crypto exchanges that are going to get to list all these assets and securities, or is it the banks that are going to start now storing crypto and getting into the digital world? So the Winklevoss twins are now offering custody of things like even your domain name address. So they're going to custody your crypto kitties, your digital collectibles, as well as all your crypto. This is the next sort of stage, which I just love where this is all going. It's so competitive and taking market share off the banks that have had it so good for so long. Samsung are adding support for Decentraland. So this is a virtual reality platform or game. And, Samsung getting involved here. This is one of the projects that I really love. I'm passionate about the gaming space. I've got some big news coming up with Engine Coin as well. I'm going to share with members very soon. More custodians. I wanted to talk about these articles because I keep saying that money will flow into the large cap projects. And just this week we saw Litecoin rip another 20% out of nowhere when a lot of people thought it was dead. Obviously, I still own it. You can see my portfolio if you remember. But more of these custodians like Anchorage have added support because it's got regulatory clarity around it. Grayscale got FINRA approval for Bitcoin Cash and Litecoin to trade publicly. So these are the sort of announcements that hopefully we can get in front of and get a bit of an edge with Sentiment, who are one of our partners, and they give us all these metrics. And the guys and I are constantly talking behind the scenes about what's happening, what are you noticing on chain or in the social sort of trends. Some more big names diving into the space this week. So PayPal partnered up with Paxos, one of the stable coins. FPOS in Australia are launching a bit of a proof of concept with Hashgraph. Japan's financial watchdog listed a Misa Go OMG token, and it's really hard to get listed in Japan. So this is another big step forward for OMG. Wirex have teamed up with Mastercard. At the same time, we've got Visa looking like they're hinting at launching their own digital currency or project of some description. Swipe are actually using the Visa cards already, and they've added Ava token for all the crypto travelings and bookings, and you know that they're partnered with the little Aussie company Travel by Bit. This is the Swipe app, and again, really, really friendly. So your different assets, there's so many good mobile apps these days. I really love how easy it's becoming. And then we've got the other end of the spectrum, like we just touched on, where the big institutional trading houses, RSX, are joining up with Silvergate Bank, joining their network. The top 5 Swiss banks, their profits are up after integrating Bitcoin. So I think I've outlined this a number of times, how nobody will want to be first, but as soon as someone does it, like these Swiss banks, and they're now profitable, all of a sudden everyone wants to jump in. And it's kind of funny that we have these, the French banks getting their different partners and trialing this digital euro. So once again, using their own coin, that I've been very, very clear that I don't think banks are going to use XRP. They're going to use their own coins and protocols. The World Stablecoin Association have launched in Switzerland. So I love this because everyone used to talk about the Swiss bank account that you could have. And we've got all these different Swiss banks that are getting into Bitcoin and crypto, and now they're profitable. But at the same time, we've got the Attorney General in New York saying we've got the long arm of the law and stablecoin issuers beware. So it's the new digital bank account instead of the Swiss bank account now. Probably one of the biggest bits of news was China announcing that the BSN public chain integration. So just more good news for Ethereum that's been pumping, but it's the EOS, Tezos, Nevos, Chainlink, Neo hasn't really run hard. So look, maybe Neo and EOS play a little bit of catch up this week. Iris Network and iRater. So some of these small account coins really went hard, pumped hard this week because this is big news. And something I guess I have outlined over the years is that my most bullish case for the Neos and ontologies was working hand in hand with the Chinese government to some degree. Now, obviously, there's no privacy with all those chains once the government is monitoring everything you're doing, but we're continuing to see more privacy techniques. Orchard, that's a decentralized VPN on Ethereum, went live this week. So this is a desktop app now for Mac users. Let me know if you've tried that one out. But the biggest piece of news was the US banking regulator giving that green light for all the federally chartered banks to custody crypto. So this is where we get to whether or not it's going to be Binance become a world banking brand. They're partnering up with German investment firms and launching different exchanges and banking partnerships in different countries around the world. They've got their own debit cards that they're now sending out. Integrating with DeFi is a really interesting one here. So Binance listed Maker this week. They also listed a couple of other projects we'll get to in just a second. But the integration of the DeFi tells you that they're going for this mix of CeFi and DeFi, so centralized finance as well as the decentralized stuff. Great to see Band Protocol, which is a little bit of a Chainlink competitor. Some say it actually complements what Chainlink does. Integrating with Icon as well. So the Oracle problem, the data feeds, it's that Chainlink have really solved a problem, and that's the reason it is pumping. So Binance have integrating Chainlink oracles into their decentralized chain as well for better DeFi. Chainlink bringing FX rates and data to Korean banks from DeFi. So these are some pretty big partnerships here. But this was the FUD that went around. Zeus Capital, look, maybe there's some truth to it. I really think that these guys put out this report and took out huge short positions. Now they're underwater and they're running promoted ads on Twitter. I saw this pop up this week. I'm sure you have too. But there's just never a dull day in the crypto space, is there? When you're running paid tweets to try and get out of your short position. FTX partnered with Thorchain as well to get into the DeFi space. FTX have continued to be leaders and adding the hottest coins, the best products. I did a big write-up for members last night, but guys, if you haven't checked out the FTX tutorials down below, it's where I do most of my trading these days. Rune got added there. I think Rune got also added to Binance, so another Aussie project. Well done to the guys that have been killing it lately. Polkadot looks like they are going to be bringing their version of Bitcoin onto their chain as well with a partnership with Ren. So that is good news. Ren has been on fire lately as well. D-Hedge, this is a really interesting concept. This is building basically hedge funds on top of synthetics. So something we'll talk about more, but cool news there. And when we look about the actual stats about how quick we've got DeFi growing, these are astronomical numbers. We went from $3 billion to $4 billion in 4 days. And that first $1 billion took, 3/4 of a year. So, yes, prices are going parabolic. Is this a fundamental that can justify it with all this money that's actually locked up? Look, I think we've probably overheated a little bit and we're due for a correction in a lot of these DeFi projects. But time will tell. When we have a look at the fundamentals again, yes, we've got miners that are accumulating. This suggests that they want their ETH, I think, to stake going forward. The decentralized exchange volumes have just skyrocketed. So some of these have now passed, Kraken and Coinbase in terms of the volume that they're doing on these DEXs. So this has happened a lot fast. And DEXs were one of my themes for 2020 in my predictions video at the start of the year. But it has really happened very quickly in just this past month, hasn't it? It comes at a cost. So when we have all this activity, the Ethereum chain is full. It's doing far more transactions, 4 times as many as Bitcoin now, but the chain is full and the gas costs are expensive. So this really hurt Maker. When they had the flash crash, because the chain was full, they couldn't execute their emergency backup system. So look, this is all part of the report that came out about what happened there, but we need solutions, and they are there. So look, this is a cool little app that'll give you alerts about things like when the price of gas and fees go lower. So check out 9000.how.xyz/discover. That's on my Twitter if you want to check that out. But we've got the confirmed date. So we are going to be launching the community-run testnet on August 4th. That's only a couple of weeks away now. That's probably one of the reasons that Ethereum pumped so hard. We've already got teams working on merging the old chain, proof of stake, into the new chain. All those different clients are talking. So it's coming along. The jigsaw pieces are falling together. The last couple of things I want to talk about related to price. Last week I did the tutorial about how Bitcoin volatility was about to explode, and there's been some really nice moves there, particularly in the 3/4 contract, which is now starting to price in a bigger move. But I still think Bitcoin has got a huge move coming very, very soon. And I tweeted this out over the next 48 hours, or indeed any weekend really. So when we go into a weekend with Bitcoin being not volatile at all, and we have these circuit breakers on the market, on the futures market, Bitcoin can easily have one of those weekends or a day or two where it goes up $1,000, and then it would open up here outside the circuit breakers, and Wall Street, all those traders would get margin calls. Some of them would actually be underwater at that point, and the Bitcoin futures don't trade again to the following day, and maybe Bitcoin keeps moving. So this is a cool opportunity for not only a huge gap to form, but where Bitcoin could actually break the futures market, which is something that, say, gold and silver have never been able to do. And people argue, well, that's how they sort of maintain the price. So very cool stuff there. Final bit of news you might have heard was that Bitcoin got ruled as money in the US. Well, it was only really in one case relevant to Washington, D.C. So, look, nothing to get too excited about there. Let's have a look at price action. This is probably my favorite chart at the moment. As you guys know, the Ethereum Bitcoin pair, we were watching this falling wedge for a long time, and this is continuing to play out. What I will say is that we have now hit this area, which might provide us with a fair bit of resistance, as you can see here, around 0.31. A big weekly close coming up tomorrow. So not only on the Bitcoin pair, but the US dollar pair. Again, this is an area that could be a little bit of resistance around this sort of 300 mark. But if we can get over there, it's basically all systems go. I mean, look at what happened when we got past this downtrend. So people and traders do tend to look at horizontal levels. They are important. It has been a big run. But Bitcoin itself is still just sitting here quietly. It's been, continuing to decrease in terms of volatility. This is starting to look like a bit of a cup and handle. That will give us a breakout anywhere from 15 to 16,000. It's only got really these couples of levels of resistance. Very similar to Ethereum, what we just spoke about. If we can get through here, there's still a healthy mix of people saying, oh, this is just another, lower high and it's going to go lower. Traders on the sidelines. But there's an abundance of new people coming into the space. It's very different to, this run up, this run up, this run up. There is, like in our group, hundreds or 1,000 new people just in our little group. Tens of thousands of new subscribers, big money, there's funds. Things are heading up and in the right direction. This isn't just a whale sort of led rise that's going to be ripped out. What I will say is that the stock market is probably the one thing that could bring us down. If stocks roll over and things get really ugly there, then like we saw last time, Bitcoin and everything, even gold has had a tremendous run lately. It's kind of at that final resistance before breaking to all-time highs. And I would really caution you again about that level. It's had a huge run. What are we seeing at the moment? Same thing as always, retail investors. How do I buy gold? How do I buy silver? When it's had this huge run. Now, maybe silver's a lot better risk to reward, but still, when charts look like this, that's when experienced traders like me say, you know what, I'm going to take some profits. I'm probably going to wait for a bit of a pullback here. Things are really hot, particularly in the DeFi space. I want to be looking at where the next opportunity is in terms of the industries, the sectors, and the asset classes. So that is why I'll continue to do those daily updates for you guys. So head over to our website, nuggetsnews.com.au, and check out our crypto community if you haven't already. Otherwise, I hope you've liked that video, guys. Please smash the like button, share these around, subscribe if you haven't already, and I'll talk to you again soon. Cheers.